Greetings and welcome back to another Meet Kevin report. It is episode 119. Today we're going to be talking about catalysts and what else is going on in the market for Monday, July 10th. A quick update. We are 15 days away from the next large price increase for the programs on Building Your Wealth, link down below. A lot of folks have been asking about the How to Make More Money with AI program. We've got some phenomenal intros for AI there. So if you're left thinking to yourself, how do I actually apply artificial intelligence in my life? Make sure to check that out. Link down below next to the Stocks and Site group. And of course, do-it-yourself property management and rental renovations and zero to millionaire real estate investing. That said, let's get into some of what's going on. So first, a lot of tentative fear right now in markets about what earnings season is going to bring. Though this morning you actually had Taiwan Semi come out with earnings that weren't as bad as feared. In fact, I would argue even better than feared, although once you go in and make some currency adjustments, the numbers are probably more mid-range. But when you just look at the numbers without massive currency adjustments here, which you kind of should be doing for fluctuations anyway, but second quarter revenue totaled $15.3 billion. That's still a 10% decline from last year, but markets were expecting an even larger decline. This is somewhat expected, though, given that NVIDIA and sort of this whole AI explosion happened within really the end of the first quarter into the second quarter. And so some of these preliminary sales here from TSM are good. It's good to see that we're not getting big misses. And hopefully it sets up a standard for what we're looking for earnings over the next, well, quite frankly, month here, because we're about to get into the thick of earnings season. And the thick of earnings season is going to, well, let's just say, test the stock market rally that we've had so far. Oh, we got an audio problem? Hold on. Somebody says the audio sounds different. Oh, yep, that'll explain it.
Sorry, my bad. Audio should be substantially better now. My bad. Well, anyway, hopefully you were able to hear all of that just fine. You were going through the iPhone earpod here or whatever. Thank you for catching that, though. So, again, audio should be fixed now. So, continuing. So, obviously earnings getting started here very soon. We're going to go through some of the big catalysts and big ones in just a moment. But you've also had a little bit of noise this weekend about China and Russia. Regarding Russia, it seems like Mr. Prigozhin potentially, and this was just breaking as of about 30 minutes ago, potentially met with Vladimir Putin after his failed uprising or revolt or whatever. And that is a little unexpected, given that there was talk that maybe the Belarusian president had to talk Putin off the cliff of wanting to kill Prigozhin, and then he went missing for a while, and apparently now he met with Putin. Who knows really what's going on over there, especially since Putin and the Russian government, via the Kremlin for a very long time, have basically created this Wagner group and funded all of their operations through shell companies, and has always in the past distanced themselves from the Wagner group, but now all of a sudden says, no, we own them, we control them, and now we're going to kick the leaders' butt. Some people are potentially rightfully so arguing that maybe this is all just orchestrated chaos to give Putin another win where, oh, there's an uprising, Putin comes in and saves the day, because it's always Putin who saves the day, right? Who really knows? I guess nobody really does. Then there's some news about, I thought this was interesting. The Wall Street Journal almost ran a hit piece, dare I say, on Disney, which I feel like is pretty rare. Generally, Wall Street Journal, I personally have found, has been pretty supportive of Disney. One of the Disney reporters actually came right here to this very studio and interviewed me right just about a week before he got assigned to Disney Los Angeles. And anyway, so now and they've always been pretty supportive of Disney, and now they're running a piece talking about how shorter wait times for rides at Disney theme parks are now expected this summer, and thinner crowds are expected, potentially due to Disney's recent price hikes, as well as some other changes to operations. But then it also makes you wonder, is it potentially because, it's a warm summer and we don't necessarily really want to be outside? Or does some of this have to do with the whole go woke, go broke thing? I guess it depends on which side of the aisle you're on. I don't know. But, I was talking about this cancel culture thing a little bit, and I was talking about the whole Bud Light crisis that's going on. And I thought to myself, I go, looking at this objectively, no matter if you're on the left or the right or whatever, if let's say this was a Bud Light and you went to a party in like Texas or Florida or whatever, and you're like, look, I just want to have a good time. I don't want to talk politics. I don't want to talk BS. Are you gonna feel comfortable walking in with a 6-pack of Bud Light anymore? Probably not. In fact, there's a chance you might not even be comfortable doing that in a lot of parts of California or anywhere in America, because it's like, oh, do you really want to start that political discussion? Who knows? It's very interesting, and so I wonder if some of that does weigh on Disney as well. Regarding some of the issues that they've been having, then you've got obviously this. If you haven't heard of it yet, there's this craze for these weight loss drugs that were actually supposed to be approved drugs for type 2 diabetes, but now there's this off-label use for these weight loss purposes via Wegovy, something like that, and that's the specific ingredient, and it's more commonly known as Ozempic via Nova Nordisk's product. Eli Lilly also has Mounjaro or something like that. Anyway, a lot of people are going nuts over these, and they're like, oh my gosh, Eli Lilly stock to the moon. I've been hearing about this a lot more popularly for the last couple months here. And I wanted to bring it up today because, I just read a story about how apparently the European Union, their drug regulator, so EU and then the drug regulator under the EU, is apparently now investigating the Novo Nordisk version due to potential reports of suicidal risks, which isn't great. This is the European Medicines Agency, and apparently now they're looking at drugs like Ozempic and otherwise related to concerns over suicide. It just seems like everything always has a side effect. We never know what that is, but anytime it's something that's probably not something we evolutionarily grew up on, it seems to have some form of a side effect. So, past the carrots and apples, I guess we're stuck with side effects. Darn it. Anyway, okay, so obviously some worse than others. All right, and now we got to hit catalysts, and we got to talk a little bit about China. We'll have some other things to chat about. Okay, so let's jump into catalysts here, but I think that makes a pretty good intro for us. So that gives us a little bit of a roundup. Otherwise, relatively uneventful weekend, which is somewhat good. All right, so let's see here. So life has side effects. Yeah, no kidding. Good point. All right, market catalysts. Take a sip here and let's get into the catalysts coming up. We got some big ones coming up starting Wednesday. Actually, a little bit today, too. Right. All right, here we go. Well, this is going to be a wild week because it is CPI inflation data week. And while we're going to go through some of the CPI projections that you should really have written down before we go into Wednesday, it is important to recognize that there are a lot of catalysts that are coming up. And this is going to lead to a testing of the stock market rally that we have had year to date. It would not be a surprise to see weakness going into the next few weeks because of the potential for negative noise from earnings and ultimately more tightening of financial conditions and potentially seeing the impact of what higher interest rates are really having on companies and earnings. After all, it's generally not every individual that's worried about their earnings power going down because interest rates are going up. No, that's actually not generally a direct correlation at all, but it could be indirectly. The way it works indirectly is rates go up, businesses have to pay more, so they have less money available for working capital and potentially are willing to offer fewer bonuses, fewer pay raises, and ultimately hire fewer people. That's at least the idea of how the Federal Reserve can shift around how the market actually functions, whether it's overheating or underperforming. When we were underperforming prior to 2020's COVID pandemic, we ended up cutting rates to 2.5%, and we actually cut under that, and then we slowly got back to 2.5%, but then had to pause our tightening cycle because, well, we were just not stimulated enough. In fact, the Fed had to keep rates at essentially a negative or a level of of restrictiveness, which is a form of accommodation. All those fancy words aside, what's important to know though is the Fed doesn't necessarily see things coming. In fact, there's a headline story on Bloomberg today that basically breaks down how Jerome Powell felt blindsided that, we ended up having a banking crisis. In fact, you can look on screen now and see it here. Powell haunted by repo crisis as Fed aims to cut balance sheet. And it's not just this repo crisis, it's a banking crisis is what they talk about in this article. Apparently, he told Congress that he was kind of caught off guard or blindsided by the impact of the banking crisis, basically the shrinking of the balance sheet and what it would have on financial markets, and the banking crisis was one of them. So when we look at these catalysts, I think everybody, you, me, our neighbors, and Jerome Powell are looking at these data sets, and we're like, wait a minute, these are actually pretty dang important because nobody really knows what's going on. And then even when we get the numbers, it's like, okay, well, to some degree, these are going to get revised. They're probably going to be wrong, but we still have to pay attention to them because they're the best we got. Kind of a bummer, but it is what you got. So what are the catalysts coming up? Well, the big ones that we've got coming up are the following. Today, we're going to have wholesale inventories coming out at 7 a.m. California time. You're looking at about a survey of negative 0.1%. That inventory rebuilding, I think, is going to be an important leading indicator for some of your earnings, because if wholesale inventories month over month continue to be negative or even more negative than expected, then that's a potential sign that some of your manufacturers for earnings might end up with weaker earnings. Enphase is one of those that I'm really looking for a beat on for earnings, but if we start seeing wholesale numbers plummet, it's going to be harder for Enphase to actually beat. We'll see. Obviously, Enphase is only going to be a smaller portion of a survey like this, if at all. Solar sector surely is represented, though. Then we'll get some consumer credit numbers tomorrow, expecting a $20 billion increase in consumer credit. That data will come out at 3 p.m. Eastern, or that'll be 12 p.m. Pacific time. Then on the 12th at 5:30 a.m., we'll be covering it live, of course. We'll have our CPI read. So CPI expectations are going to be up from last month's 0.1% month-over-month rise, and we're expected to jump to 0.3%. Food and energy month-over-month expecting to go to 0.3%. That's up from 0.4%. Year over year, dropping from 4% to 3.1%, especially as we get that big year over year comparison, where we're comparing to the highest level of inflation that we had in the last 40 years, which was, of course, June of, 2022, which means now we are finally going to lap those numbers. So we'll drop from 4 to 3.1 is the expectation, but core staying a little bit more sticky, going from 5.3 to about 5. And of course, it takes time for the numbers to fully come down. And boy, oh boy, we can't wait for them to come down more, because maybe then we can finally be convinced that the Fed has gone far enough. But there's also the fear that people are going to spend more money on core services, whether that's used cars, car rentals, hotels, travel accommodations, flights, whatever, ultimately leading to a rise in core inflation more than expected, which wouldn't be good. It would probably be the nail in the coffin for a larger rate increase this year, which is probably going to be a July 25 basis point hike, and then maybe also a September 25 BP hike, depending on reports like these. Obviously, if we get a weak report, inflation is coming in lower than expected, then that would be wonderful. And it might be a reason for the Fed to relax, and maybe the bond market then will price out some more of these increases that we've been seeing. So far, though, the Fed rate monitor is giving us a pretty good indication that we've got a 91.8% chance of a hike in July. And that next meeting is in 2 weeks, 2 days, and 6 hours. and a 71.7% chance of a pause in September. Keep in mind, while this is happening, you're also still seeing those treasury yields stay pretty stably strong. Over 4% on the 10-year is pretty dang strong. We're at 4.045-ish, right in between there right now. Continuing with the CPI catalyst here, you end up having, what do we have? A high estimate of 3.3, a low estimate of 2.8, and this is for the year-over-year figure, by the way. And the median estimate is 3.1. So it gives you a little bit of insight into CPI here. Of course, again, we'll be getting a lot more of this data in just 2 days as we can actually go through the report. Now, when it comes to the expectation for core month over month, the current median estimate is 0.3. The average estimate is 0.27. So a little bit skewed just under about 0.3. And your range is anywhere from 0.1 to 0.4. So no negative here in terms of prices going down, which I know many people are excited about, especially as we see potentially housing and shelter inflation start show up in the data and hopefully weigh down some of these CPI figures as people can finally get a good deal on rent again. The next day after that, so this will be Thursday morning, we'll end up getting PPI data. PPI, obviously, producer price inflation. Now, that's pretty important. First, let's take a sip of this monster here. Cheers. That is not sponsored. I just want a monster this morning. But you can learn more about my perspectives on building your wealth via those programs linked down below, because guess what? July 25th will be the next date that we have a large price increase. So make sure to join the programs before then. Zero to Millionaire Real Estate Investing, do-it-yourself property management and rental renovations, stocks and psychology money, and of course the income course featuring AI to make more money. So PPI expectations are 0.2% month over month, core 0.2% month over month, core also excluding trade 0.1%, and then PPI year over year final demand just 0.4%, with core at potentially down year over year to just 2.6%. Pretty good. Those PPI numbers tend to be a strong leading indicator of inflation, and that's an important thing to consider. The more we continue to get these lower and lower PPI reports, the lower it's likely CPI inflation is going to end up trending. So producer prices tend to be a very good leading indicator. So then we've got initial jobless claims expected for Thursday at 250K, and jobless claims continuing stable at 1720. These numbers have been pretty stable so far. Only place we really ended up seeing any kind of oopsie doopsies was in that jobs report last Friday, where we ended up getting a much weaker report than expected. Then on Friday, we'll be getting the University of Michigan Consumer Sentiment and Inflation Expectations Report, hoping to bring that one-year inflation rate down again as well. Remember how important it is that inflation expectations come down. Very important. Inflation expectations via the 5-year break, even right now, are sitting about 2.22, so about stable to where we were last week. Then we have the earnings calendar. This week, we're looking for tomorrow after, let's see here, that's Tuesday the 11th. We have actually not much of anything on Tuesday the 11th afterwards. It's not until Thursday the 13th that you get Delta Airlines. The airlines are always some of the earliest to report. So you get Delta Airlines, Fastenal, you get Pepsi. Maybe we'll see some of that inflationary progress that they've been bragging about for price increases go away, which would be fantastic. After the market closes on Thursday, we'll be looking at what is this? Organigram. It's really one of the only ones that we've got there for Thursday. On Friday, we'll get in the morning BlackRock, Citi, and JP Morgan, as well as Wells Fargo and State Street. These are massive reports, and they're quite complicated, but they give you a lot of insight into that consumer. How much of that consumer savings is still around? We want to know. We want to know the answers. And then, of course, nothing after the hours or after hours on Friday. Now, as far as Next week, that's where things start getting pretty entertaining. You've got Bank of America, Bank of New York Mellon, Lockheed Martin, Charles Schwab, Morgan Stanley, Novartis International, PNC. These are all great companies that we'll be evaluating. After hours, you get JB Hunt. We'll see how that recession is going for the freight sector, as well as Interactive Brokers. On the 19th in the morning, you'll get Ally Financial, ASML, as well as Halliburton, NASDAQ, US Bancorp. And then after hours, of course, we'll be looking for Tesla, Steel Dynamics, and Netflix, as well as Equifax is over here and some others. Let's see, United Airlines will report then as well. That's on the 19th. On the 20th, we'll be looking for American Airlines, Blackstone, D.R. Horton. D.R. Horton will be fantastic. Johnson & Johnson, Philip Morris. That is scheduled for the 20th. And D.R. Horton will be really interesting because a lot of folks are just expecting that the home builders are just continuing to crank out properties because, frankly, they can because there's so little inventory for houses. And this is true. We're waiting for that inventory to rise, but boy, oh boy, every time I go to the Redfin data center, it's just not something I'm seeing yet. And when I talk to agents locally for leading indicators, even though everybody's hoping for more inventory, it seems to be that everybody kind of says the same thing. Well, we'll have to wait and see because we just haven't seen more inventory yet. So then you've got earnings. Let's see here. So that's on the 20th. And then in the morning, you'll have American Express, which will give us a nice little look into that higher end consumer, as well as Roper Technology. And we've got, that's probably it actually for Friday the 21st, and then nothing after hours. So that gives you an overview really of the next 2 weeks here of some of the catalysts to pay attention to. My hope is that CPI core, I'd really like to see that come in lower. That's a big deal for us. And it's been one that's been very, dare I say, frustrating to the Federal Reserve. And coming in with a core number of 5%, not fantastic still, even though it's going to trend down from that 5.3 and it's slowly coming down. It is something that is going to take some actual patience to get down. And the reality is nobody's got patience in the stock market. So I could show you graphically, though, how core CPI has been moving. And I think the graphical representation is quite useful because, well, it shows us that, yeah, look, it's taking longer than expected, but it's happening, right? Now, that's what we want. We don't want to turn into a United Kingdom where we end up getting some kind of spike up on the right side. That would be very devastating for America. So we'll have to pay attention and wait and see how these numbers come out. But in 2 days from now, we'll be seeing those. So that covers this segment. Make sure to check out the programs on Building Your Wealth link down below. Let's continue on. Let's listen in over here for a moment.
Yellen is over there. Are we? Can we start investing in Chinese stocks again? I mean, there's people like Kyle Bass think you're out of your mind with the, I don't know, less stringent regulatory oversight and sort of avoiding some of our regulatory oversight here. Is it? Right. Are we friends again?
Well, look,
everything okay?
I love Kyle because he does his work. You see, he digs in, he does his work. We had 2 cabinet secretaries go to China in the last 3 weeks. What are that telling us? We have a time of dislocation in the global economy. They recognize that we need China, and China needs us in order to get through this period of dislocation.
Get down the rhetoric more than anything, right? It's not that we're going to change behavior so much as change the way we say things, is what it felt like to me with this, where she's saying we're not going to use words like decoupling and de-risking. They're talking about diversifying. It's the same thing, but she said it like this, right?
Well, look, we are in a place in our relationship with China where we are overly, there's no doubt about it. I don't think anybody takes the other side of, we're overly dependent on what I would say is a vicious competitor and somebody who on the world stage would like to displace us. No one takes the other side of it, but we're there. What do we have to do? We have to recognize how codependent we are. I actually like the Elon Musk co-joined twins. We are very much stuck together economically. I think what we're seeing is not just so much going, let's say, going positive, but if things were to get more negative, it would be very difficult to get through this time of economic turmoil. I think that's the judgment that this administration is making. demonstrated by sending 2 cabinet officials to say, let's try to work our way through this
And you agree
in the
with
near
that?
term. Look, I see both sides of the argument. I see that now is the time where the United States is in a position of relative strength to start decoupling, to be making those strategic moves. I also see the fact that any kind of abrupt mistake in U.S.-China relations is going to have an adverse effect on the economy. This is going back to Joe's negligence point.
Right.
There's no perfect solution here. We could do a better job of understanding where is the end state that we want to be 5 years from now, 10 years from now. I don't think we want to be as dependent as we are today.
Last week, when the judge made that ruling, I thought I was horrified, but I understood that the government was trying to get everyone to get the vaccine. So I could understand why they'd call Twitter or Facebook and say, don't let that negative stuff about the vaccines. I don't want to see that. I understand why they did it. They wanted to get everyone vaccinated. So, but in hindsight, that was bad. Suppressing a lot of things was bad. But then I saw some people from the FBI say they need to be able to talk to social media about things they see on Twitter or Facebook to protect people, to protect the country. They need that access, and this would preclude them from doing things. What's the right move? And will this stand up? Does it go to the Supreme Court?
Yeah, let me try and draw a distinction. I think that government officials should come on this program. I think government officials should call reporters. I think they should inform you as to what they're thinking, why they're thinking it, give you the facts. We want that. I mean, they are in a unique position. What we don't want them to do is call up a regulated entity, for example, and say, here's my view of the world. And by the way, if you don't accept it, regulation is going to get tougher. Once you go, the case is very interesting and it's worth a read. The judge does a very careful job of saying they went over the line from information to coercion.
To a court
Now we can.
there will be consequences if you don't.
Yeah, that judge regarding the limitations on potentially the Biden administration, that was an intense read. We've covered that a few different times. Just type into YouTube "Meet Kevin Censorship" and you can see the last 2 videos I've posted about that and the reasons. Okay, so let's see here. What else do we have? Well, we could talk about China. That's another one. Okay. All right. Let's talk about China. So let's see here. Let's get that. 1 second. All right. Cool. There we go. Well, China made massive news over the last, 36 hours here as China's inflation rate once again fell more than expected. In fact, if you look at producer prices, you ended up seeing producer price expectations at 5% to the negative, and they actually ended up falling 5.4%. So in other words, you've got straight up deflation in consumer prices. And boy, we would love that in America. We would love the talk about inflation and prices going up to actually translate into prices going down. Well, in America, even though you might have an inflation report that's called the consumer inflation report and the producer price inflation report that often gives you a leading indicator of consumer prices going down, that is, hey, the factories are spending less money because they're not having to bill as much, which means stores could also be more competitive by dropping prices and you end up selling more, right? Anyway, the idea is that if you have producer prices falling, it's just a matter of time before consumer prices come down. And China's already started to see consumer prices come down. But a big miss on producer prices is another sign that now people are starting to claim that China, rather than actually contributing to the inflationary nightmare that everybody thought they would at the beginning of this year, China could actually contribute to deflation. That's called basically exporting deflation. When you're fighting falling prices, so you keep lowering prices at your manufacturing facilities or whatever, and that ends up self-fulfilling lower prices in the future for consumers. And it's great in the short term for consumers, but it makes a lot of people very nervous. It makes people think that there needs to be economic stimulus from the People's Bank of China and you are getting some of these, such as some easier mortgage application standards that are just starting to be implicated. But China is not the kind of country that'll just open up the pocketbook and start issuing stimulus checks. It's your responsibility as a good Chinese citizen to make sure you have enough money to get you through any kind of issues that could come up. And this lack of stimulus and lack of urgency for stimulus is something that they think will be very prudent long run, which it may be, but then they could also fall into a depression of deflation, much like Japan had in the 1990s. And that could end up happening in China, the second largest economy in the world. Now, some of this PPI deflation that China saw was driven by declines in oil and coal. Oil, even though OPEC keeps talking about these cuts, oil prices really aren't seeming to move terribly much. We've what's felt like been relatively consistent with seeing oil somewhere around 70, maybe 65 to 75 bucks for quite a while here, up to 80, not uncommon. And that's where we sit now. WTI sitting at 73.48 and Brent's at 78.09. And so a lot of people saying, hey, China, get with the program here. We need you to start stimulating. And China's kind of like, yeah, we don't do that. We'd rather give borrowers for real estate easier deals and let government partner with various different business ventures in China and lend sweetheart deals over to those businesses. Unfortunately, once you kind of screw with your economy, you end up either having a lot of inflation or a lot of deflation as you don't keep things in balance. And really, some of the things that could be keeping China out of balance are, well, the following. Number one, it's very likely that their saber rattling about the United States and Taiwan usually ends up falling on deaf ears, and I think this will as well. That is this certain period of time that we're in right now. I don't think China really has a position of power to say, hey, our economy is so great, let's finance a war. I don't think so. Although some argue that a war could actually be inflationary, which is somewhat what China wants right now, along with Japan. They're trying to get those rates up. But consider this. When it comes to potentially having inflation in China, it's also worth noting that China is starting to produce a lot more of its own oil. They're still only at about 28.7% of of oil that China needs that they actually create locally. But that number is growing. And so the idea is, okay, more competition for pumping and selling oil could actually continue to reduce the power of OPEC even more. So I kind of like what's going on in China. They're trying to be very disciplined with their expenses. They're trying to prevent creating bubble economics. They're investing in the manufacturing of oil or processing, I should say, of oil themselves, since obviously you don't manufacture oil. But in the meantime, they are potentially facing deflation, which even though markets might initially look at that and say, wait, this is bad. If they're facing deflation, we're going to cause a deflationary spiral. I highly doubt that is likely to happen in the United States. The reason for that is the United States will actually just turn on the money printer. So in other words, as the unfortunate Chinese suffer with no money printing and no money printer coming their way via a stimulus check or otherwise, the more they export deflation and the cheaper it is for us to use Chinese goods and services rather than potentially our own, even though I'm not saying that's a good thing. I'm a big fan of supporting local businesses. A lot of local businesses we support. But most importantly, you've got to consider, wait a second here. If China exports deflation and they end up in some kind of depressionary environment, then that will be a good thing for the United States. And so even though short-term people say, wait a minute, export deflation, recession in China, couldn't that mean a recession in the United States? Not necessarily. I don't think that's as much of a foregone conclusion. So let the deflation reign then. And the crazy thing is, as deflation is occurring, China is basically trying to manufacture, or I should say produce and drill for even more oil, so that way they're less dependent on that international oil. Although they're getting some pretty cheap stuff from China or from Russia right now. All that said, China, as a result of this sort of fear that we have going on, is facing potentially some big selling. up to potentially $28 billion of cash that's locked up in Chinese mutual funds that's about to be dumped potentially onto the market. There are a lot of redemption periods opening up over the next year to two here. And these redemption periods coming at the same time about China potentially entering a deflationary depression or recession, whatever we want to call it, and falling prices could end up leading Chinese stocks to really get hurt. So take a peek at some of those mutual fund redemptions going on in China if you have exposure to China. They are trying to ease mortgage rules, again, trying to spur the real estate industry. So far in Hong Kong, prices for real estate have fallen about 13% from 2021. And ultimately, even though you've got a lot of people still very bullish in China, there is a lot of fear that, maybe it's just going to be the select few that end up going into a recession, and China always seems to be on that list. So stay tuned and buckle up, I suppose. But bottom line out of all of this is you have economic problems in China. You have deflation. You're in no position to invade a country like Taiwan. You're better off being more of that peacemaker or peacekeeper that you've been playing in terms of a role. China's been bragging essentially about getting Putin not to use nuclear weapons. And it's like, okay, hopefully he could have had a cooler head and not anyway. But hey, if China wants to take credit and they helped with it, fine, let them. So again, point here is if you're looking to invest in foreign countries, probably be somewhat careful with China. A lot of people who are buying right now are saying, well, I mean, I'm buying the bottom if I buy right now. Some of these companies are valued so lowly. This could be true, in my opinion, in America. We have no idea what their monetary and fiscal policies are going to end up being once they do actually enter into a recession. Here in the United States, if we entered into a recession and inflation proved to be transitory, the Federal Reserve would cut rates faster than you can even think about it. Remember what they did in March of 2020, COVID time. They literally on a Sunday reduced rates to zero just to try to prevent the economy from going into a tailspin. So we'll see. Anyway, so regarding China, make sure, as always, you look at your earnings for your companies and you evaluate, hey, how much of XYZ company is actually exposed to China. I think it's a great thing. I think it's a thing that a lot of people end up missing, but is what it is. So look at your AMD, somewhere around 25%, NVIDIA, somewhere around 25%. Look at Tesla at somewhere around 45%. There's a lot of business that heads into the Chinese economy. And deflation there, again, it's great for us because you can now buy stuff even cheaper in China, but it could have far further reaching implications for the Chinese economy. So keep that in mind regarding China. All right, let's listen in over here again.
I remember gas was like 50 or 60 cents a gallon. Like, and we didn't know about OPEC. We didn't know that something like that was going to happen. We didn't know what gas lines were, and it all happened at the same time. So it was to see 21.5% prime rate, and you thought you could never buy a house again that fit. So those numbers you just said, did you say 11? The Fed funds was
11 to
11
20.
to
Yeah.
Fed funds 11 to up to 20. And so it does make any comparisons to that time period seem, I don't know, like
Pale.
Yeah, it might not pan out that way. Mike, thank you.
All right.
See you. All right.
All right, let's talk more about the markets. This morning, Citi downgrading its U.S. rating to neutral from overweight after a solid first half of the year. The bank upgrading Europe in the meantime to overweight. And joining us right now is Noah Blackstein. He is senior portfolio manager at Dynamic Funds. Noah, how do you feel about where equities might be best positioned at this point, given the huge run-up we've seen in the U.S. the first half of the year?
Well, I don't think, toward the end of last year, everyone was saying, get out of technology, get out of everything. And everyone's completely caught off guard on a year-to-date basis. So, I think taking a longer-term view, I think is certainly important. I mean, if I'm sitting here today looking at Wednesday's CPI number, headline will be around 3%. June 2022, it was 9.1. So some of the key components of core, whether that's used cars or owner's equivalent rent or other things like that, also, have not shown weakness versus more real-time data, which have. So, we're at 1/3 the inflation we were about a year ago. And the economy thus far, I think the ADP number was kind of out of whack, but we're sort of seeing a jobs number of a couple 100,000. And so, I'm for now always wary of Federal Reserve mistakes or trouble in credit. For now, I'm kind of in this a little bit more of a Goldilocks type of scenario, which I think bodes well for certainly equity returns and certainly those companies with secular growth opportunities.
Let's talk about earnings season because we really get into it later this week. There were a couple of notes out this morning. Yeah. Goldman Sachs saying that, they think that companies will be able to beat lowered expectations. And so you could hear a lot of good things coming out of surprise upside coming out of earnings. On the other hand, you have Mike Wilson over at Morgan Stanley saying, look out, it's going to be bad. They're not going to make some of these numbers. Which camp do you fall in?
I fall into sort of listening to the companies that you kind of own and their kind of view. I would say that, there are certain areas that are going to be under tremendous amount of pressure in financial services, for example, which have been dealing with this inverted yield curve, just this expensive deposits and other things like that. There are other areas where things seem to be okay in the consumer space and the restaurant space. Certainly, we're seeing a reacceleration in cloud migration in the technology space, driven by a lot of what's going on with AI. So you really do need to kind of pick your spots, obviously, as you always do. The other thing I would say is that I'm really not hearing anything about supply chain or cost pressures like I heard about a year ago.
Yep.
And so, if it's an inline top line number with better margins, I think the market would react well to that.
What do you like, Noah, specifically?
Yeah, as a growth investor and secular growth, I think I've been doing this for a long period of time. I think I started when Windows NT and that thing Mosaic browser was coming out in the early 1990s, but I've never seen sort of everything sort of come together like it has around AI and whatever you want to lump in there, machine learning, big data, and everything like that. We didn't really know what the ROI on a desktop computer was. We didn't know what the return on investment of Amazon was in the 1990s. But we're seeing real tangible return on equity for AI-powered chatbots, for dramatic reductions in call center costs. We're seeing automation and factory automation in terms of efficiencies that companies are getting. JP Morgan talking about driving sales processes with AI and reducing fraud. And so of all the cycles I've seen in technology, I've never seen one with such a tangible ROI. And I think longer term, this is it's a very, very
totally agree, which is why we have a course on getting you started with AI and making more money linked below.
A lot more data and a willingness to harvest that data and analyze that data significantly stronger with better margins and then, in fact, accelerating sales over time. But this is the coming together of almost 20 years of technology build and spend in the cloud and big data, and the implications on the upside are significant. Obviously, I do listen to a lot of these debates on labor and labor costs, and just remember, economists treat technological change as exogenous. We don't know what happens; it just sort of happens. I do worry a little bit of all this hyper focus on labor costs and other things because I don't know what the longer term AI impact is to labor. Some people have it low as 75 million jobs lost. Goldman has it as high as 300 million jobs lost. People will be offset in other ways. But that's the one area where I think this hyper focus on labor might be missing a bigger picture.
I don't know if you saw 60 Minutes last night. They did a deep dive on Alphabet and what they're doing with AI, the battle that they're in with Microsoft to try and see who's going to win at this. Do you have a favorite when it comes to what's going on with AI? Somebody you think comes out on top, or is there room for lots of winners?
Well, I think AI is a data strategy, and I think, whether it's data lakes or databases and all that in the cloud, will continue to benefit. I think the big winner longer term are the Walmarts and the JP Morgans and the McDonald's and all those companies who are going to be better at advertising with generative AI, are going to be more efficient in warehousing and reduction of fraud and other things like that. So,
the AI stuff is really pretty incredible. How much it's going to translate to actual earnings for some of those software companies, that part remains to be seen.
That's the fun of being an active manager. We'll see how that progresses over time. But the longer term theme is extremely powerful.
That shot just.
That's what I was going to say. Is it WeWork?
It just makes me sad. That shot it just makes me sad. What's behind it? You got no book. The shot. Yeah. You got no books on the shelf.
Is this your first day back to work?
You can buy, but there's no personal effects. It looks like one of the people in Severance at their little cubicle. It's depressing. No, it's depressing. Where are you?
I've been institutionalized for the last Joe, we moved into new offices, and the boxes are out at the shop. But I can move the.
You can buy fake books for God's sake.
Show us. Prove there are boxes there, Noah, because we were wondering if that's WeWork.
Some family photos of something? Are you? I mean, a little guy on a horse? Like a Reagan? You got nothing.
I'll load it up for you. I'll unpack the boxes.
Do not come on like this again, Blackstein. Do not. You know what? We were able to focus on everything you said. We certainly weren't distracted.
You were.
The fact that you said that means I'm going to take every book off the shelf next time.
You'll never have anything to look at.
They're so lonely.
I was going to ask the same thing. That was my last question too.
I'll open the process.
I'd go back home remote.
Thanks, Noah. Hey, can I tell you who I think it is?
Yeah.
I'm trying to play this out.
Which state?
Okay. I have a really good clue from, again, Twittersphere. Guess where Vicks Vapor Rub is made?
The rub? Where?
Greensboro, North Carolina. And the Biltmore, if you look it up, is built.
All right. Anyway, that was quite awkward. That poor guy, they made him seem like he was going to cry. I don't know about you, but that poor guy, I was looking at his face and he's just like, man, why are they making fun of me, man? I'm just here trying to give them my opinion on the economy. And here they are just railing on me. That's kind of what it felt like a little bit. Oh, I feel bad for the guy. But wow. Yeah, oopsie doopsies. Don't go on to CNBC with a boring background. They'll stop listening to whatever you said and just talk about your background. Hey, maybe they should have me on, and then they could talk about my pretty colors. Anyway, all right. So let's take a peek here at El Sticos. What's going on at the Sticos? So we got Tesla's actually up in the pre-market here at about 0.6%. We've been sitting there for about a couple hours here. Tattooed Chef 26 cents, Enphase up 43 bips here. Rivian again up with about 3% here in pre-market, up 14% last trading day on Friday. It's been really moving away from this idea that, there's bankruptcy risk. Even though there's still a bankruptcy risk, traders have been trying to move away from that idea. And it sort of created this self-fulfilling prophecy of the stock moving up, especially since they had somewhat of a beat on deliveries when they last reported. So then you've got, what else do we have here? Starbucks, 0.15, Airbnb, 0.13, Apple down again, 0.34 cents. Apple's really running into some resistance. The Wall Street Journal just put out a piece talking about how Apple's rollout for their new headset might actually be a lot slower than expected. They're thinking about doing appointments essentially for you to try on this virtual reality headset. Personally, I'm kind of like, I'm not going to an appointment to buy this. I hardly want to go to any appointment. I like being able to do what I want in biz, and so having a schedule is hard. So I personally not a big fan of yes, let me go make an appointment to go to the Apple store. It's just not a priority. But if I happen to be at an Apple store, I'd like to walk in and maybe I'd buy something. So I don't know how I feel about that whole appointment only thing for the headset, but whatever. Part of it, they say, is because they're having a lot of supply chain issues actually being able to manufacture enough of these. So in a weird way, that probably means it'll sell out. People price gouge it on eBay. You'll end up seeing this $3,500 headset selling for $9,950 and 420 cents, trading on eBay or whatever. So there'll be some madness and craze for these headsets, I believe, especially if you're going to be creating these in-person appointment-only setups. Hopefully, you could just buy it on the app and forget about it. But who knows? Anyway, even though supply chain issues are mostly faded away, when you have a new product, you're creating basically new supply chains, and they're sapphire style glass that's inside of the actual lens is going to take quite a while to really mass produce. It's one of the benefits, by the way, of working with these big companies. If you're a manufacturer, is they always have a new idea, and it's like, all right, now we want to manufacture this. Here's how we think it should be made, and the manufacturer's like, all right, well, I don't know about that, but we could try this. Anyway, everybody kind of learns that way, which is the whole point about having a good relationship between a supplier and either a manufacturer or otherwise. The same is true for even a company like Tesla. When Tesla comes out with a new concept for a machine and somebody else has to manufacture it, like whether that's the electric motor or otherwise, that company learns just in the process of actually manufacturing what they're making. So it's win-win. All right, let's listen back over here.
On Wednesday, and if you didn't combine that with the last couple of months of job growth, things are, I don't know whether it's because of any of the recent legislation, but you would have some things that you could definitely say are very positive in the economy right now.
Yeah, I think the numbers make the case for Bidenomics. I'm happy to come out here and talk about them, but these are facts. So, of course, we've had 13.2 million jobs since this president got here. And yes, we've seen some cooling in the job market, and that's necessary and important if we're going to appropriately align labor supply and demand. And by the way, when you just tick through the jobs numbers, you hit the highlights as you well should. But I actually think one of the biggest highlights in there is the improvement in labor market participation. This is so important on so many levels.
Honestly, I can't stand listening to this just nonsense. It's like so single-sided, so biased. It's not all great. I don't know. I can't listen to that. So anyway, I don't need to surround myself with more good news. We got to pay attention for bad news so we can find some opportunities. Anyway, of course that's his job, but that doesn't mean it's my job to listen to it. Anyway, all right. So we covered Ozempic. We covered a little bit on China. I thought the oil production piece was actually interesting. We covered Catalyst and JPow, and then we covered actually a lot of good stuff in the intro. So I'm going to have to cut today's a little bit shorter, probably. Let me see if we have data coming out here is that in a few? No, that's at 7 a.m. We have data coming up. So we're going to cut today's Meet Kevin report a little bit shorter today. Sorry about that. And we will see you all in the next one. Thanks so much for being here. Check out those programs on Building Your Wealth link down below for more Meet Kevin. We'll see you soon. Thanks. Goodbye.